Hey guys, welcome back to another video, and today we're going to be talking about how to use Fidelity to research stocks and buy stocks on it. So you're going to start off on, when you log into Fidelity after you've created your account, you're going to have these tabs, investment products, accounts and trade. You're going to want to click on, mutual funds. I wouldn't recommend just buying single stocks. I don't think anyone would ever recommend that. That's just too risky. But for now, we're just going to do mutual funds. And so, yeah, you see it says open account. You can open account there. Go to, explore a fund offering. And so this is where it kind of like blurs the lines between, how to actually invest in these things. So look here, we have like a large value. Like, what does large value mean? Small, mid, income oriented, large blend. So what these all mean is basically, large value. These are going to be companies that are worth, billions and billions of dollars. You're investing in these. Large value means very big companies. Small and mid value is going to be smaller companies. Like, let's say, oh gosh, Raising Cane's, you know, had an IPO and they're on the stock market now. Well, they would be a small company, so they would be under the small value index. And so, income oriented or like dividend related. So if you're a big proponent of dividends and you like the income, you can invest in those. But typically, dividends pay the same amount in return because, based on fundamentals, you subtract the dividend from the stock value, and it's just all this complicated stuff. Essentially, it doesn't really matter if you invest in dividend stocks versus, growth stocks, but it's just, a preference. It's like a fad. And so you're going to look at these like large growth. I mean, these are like, Apple, Google, Facebook. These are, large companies that are growing. And, small mid growth, these are companies that are just starting out. So, like baby Netflix when it was like $12 a share. Yeah, you want to invest in those, huh? Yeah, that's where you do it. Let's just for shits and googles, let's click on this one, Blue Chip Value Fund. All right, so you're looking at this, and overall rating is a 1 star. So I'm not a financial advisor, but I don't know if you need to be to tell you that a 1 star rating sucks. So returns low also sucks. Expenses, they're low or they're on the lower side. It's okay. But then you look at this risk category is in the middle. That's really bad. Yeah. That means you're getting low return for basically middle risk. Okay. So let's look at the performance. So when you're looking at the performance of an index fund, what you want to see is, or a mutual fund, my bad, is index funds. They're the same thing. There's a difference I'll explain later. But, when you're looking at a mutual fund, you want the returns to be pretty good. I mean, you want to see higher than 7% here all across the board. Sometimes they're not going to be. Sometimes, you want to see higher than 10%. I mean, let's be real. You want to see big numbers, big boy numbers. These are so low. I mean, come on. 7.78? Man, I made more on GameStop. Anyways, so, year to date is 9%. That's pretty low. So, but you look over here. You got to look over here at details too. And so we can see this has a 0.63%, which is pretty low. I mean, that's less than 1%. That's pretty good. You want a low turnover rate. Why? Because higher the turnover rate, the more you're going to get charged by these companies, by Fidelity. So that's what this expense ratio is. Saying, every time we churn, basically every time we sell something, like a stock in your portfolio, blah, 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 in the mutual fund, you have to pay this amount. And so having that low turnover rate means, you're going to get more money for whatever you're putting in. And so you can see the top 10 holdings here, Berkshire Hathaway, go figure. Every freaking mutual fund has Berkshire.
We get it.
So, Comcast, Cisco. So if you like these, good. If you don't like them, you can always invest in something else, right? But other things you want to look for, the fund overview right here. You're going to want to read this on your own time. But basically, you want to have some common sense. You want to look at, what they're doing in terms of risk management, what they're doing in terms of strategy. I mean, obviously, if this is a blue chip value fund, you're going to want to make sure they're investing in blue chip companies, which it seems like they're doing. But you just want to make sure that they're following. The name follows the strategy. That is very, very important. And it sounds dumb and it sounds simple, but trust me, it's very necessary. So in terms of this one, there's different tabs you can click on. I mean, look at this. This is pretty. Look at that. It compares it to the Russell 1000, and you can see that the Russell 1000 does better. The large value, I mean, that does better actually, yeah. So this thing's telling you verbatim right here, this thing sucks. It sucks a lot. You can even see, it even tells you right here in quarter and average annual total returns, it tells you after taxes on distributions. It tells you how much you're gaining on your money after taxes and on distributions. So look at that. It sucks. It sucks. Look at this. I mean, you just look at the numbers. They suck. Like I was expecting like these. Like look at the Russell 1000. I was expecting like this. But no, we get crap. Yeah, so don't put your money here. And you want to do this for, retirement. Like I get if you want to open up a Roth IRA with Fidelity, that's all fine and dandy. But you can only put 6,000, 7,000 a year into it. So you're going to have to use your 401k. And so you're going to have to do this with your 401k too, people. You can't just blindly throw, 3% of your paycheck per year into, whatever crap you're throwing into. You pick the default. Default investments are usually really crappy. They're like BlackRock mutual funds or target date mutual funds, and you don't want target date mutual funds. I don't need to be a finance advisor to tell you not to do it. All you have to do is look at the numbers. Like, just compare. Like, they suck. And so, yeah, I mean, you can even go into like news and research. I don't typically do news and research because, I mean, the investment products speak for themselves. If you go back to mutual funds, you can even look up index funds, which are basically mutual funds with, no expense ratio, hardly any expense ratios. They don't turn over. So they don't sell the stocks in the mutual fund that often, which is great. It's what you want, but it's not an actively managed fund. See, you're here, not an actively managed fund. And it's not an ETF because ETFs can be traded like stocks. They're basically mutual funds on crack. And you want an index fund for long-term investing. I mean, actively managed, mutual funds can do well, but you have to do a lot of research to find those. So, I mean, look, I mean, these are mostly like crap, but if you go to like find mutual funds, select by class and category, US equity, US stocks, right? Large blend, large growth, large value. You really want to get all of them. Let's just do that. Fidelity funds only. You can see no transaction fee. And then you can even do it by risk. Look at that. You can change it by risk. So I can increase the risk. See how there's nothing at max. There's no matching funds here. Okay, so we get that, right? Put around right there is good for someone like me. We want an overall rating of high. Ooh, expenses low. We have one fund. It's a small cap index fund. And look at that, life of fund. It hasn't hit 10 years yet. So pay attention to that. If it doesn't hit 10 years, that means gains, these numbers are a little bit misrepresented. You need more time to average them out. I mean, 5 years is a good amount of time, but they have funds that have lasted like 20 plus years. And so that's going to give you a better idea of how it's going to average out in the course of the next 20 years. I mean, it gives you an idea. Obviously, you can't base the past on the future. But I mean, life of fund 14.65% is litty. So, yeah, I mean, look at this net expense ratio, 0.026%. I mean, that leaves you with all those gains. You want those gains, people. So, this is something that most people should invest in just because of the numbers. They don't lie. I mean, these numbers don't lie, people. I mean, look at that. Those are sexy numbers. So you want to take all that into consideration. I mean, you can click on it, you can look at it more. Like if I click on it here, it pulls it up. You can see what it's investing in. Highly recommend, making a Fidelity account in general. I mean, gosh, this is just hot. This whole system is amazing. And, I mean, I use it all the time and it's really great. And they have a good Roth IRA, and my company used to have them for their 401k. So I mean, it just works. And so, I mean, it's not sponsored, because I only have like 46 subs, but who gives a crap? Anyways, but that's about it. Hopefully you found this information helpful, and subscribe if you like the content, if you want to hear me rant more. But that's it. See ya.